who has a question who doesn't want to have his license. Good evening, everyone. I am Mark Fischer, the chairman of the board of Ag Plus Cooperative. Joining me this evening is our president and CEO, Todd Ludwig. We're happy to welcome you to our first ever Ag Plus annual report. We would have preferred to have a normal annual meeting, but with the COVID-19 restrictions in place, we felt that this would be a good way to inform you on how our first year went at Ag Plus. With that, I'll turn it over to Todd.
Thanks, Mark. Good evening, everyone. Before we get started here, I'm just going to give a few instructions for the webinar here. I know it's new to a lot of people, and we'll first of all participants are automatically muted when you join. If you have questions or want to make comments, you can look at the bottom of your screen. You should see a little hand button symbol down there. If you click on that, it'll notify us if you have a question. Kind of raise your hand and we can take you off mute and you can ask your question. The other option you have is you can click a button at the bottom of your screen and type your question or comment. And at that point, we will respond to the question. The webinar is being recorded. It will be available to be watched at any time following the conclusion of this webinar, so probably tomorrow. You simply need to go to Ag Plus website and click on the link. You know, just in case it was so good you want to watch it again, or but most likely if you want to have another family member, business partner, or neighbor, anybody that didn't see it, certainly want to make it available for everyone to see. This report serves as Ag Plus's annual meeting for this year. Again, as Mark said, due to the COVID-19, the governor of Minnesota actually issued an executive order relieving cooperatives from having annual meetings. The following slides will illustrate the state of the union for Ag Plus. There are audited financial reports available at Marshall, Canby, Minneota, West Branch, Slayton, and Ghent locations if you want to stop in and pick one up. It's a shortened version that we would normally hand out at the annual meetings.
So I guess I would like to give you guys a little idea on how we came up with our Ag Cooperative, or our Ag Plus Cooperative mission statement. Last February, our board held a retreat in Marshall here, and we had a facilitator to kind of help us out with it. And we went over many different things, but one of those was that we should develop a mission statement. There are many different ideas that the board members and management staff and everyone that was included came up with. But at the end of the day, what we came up with was, for our mission statement, was to enhance patron prosperity. As a cooperative, I feel that's exactly what we need to accomplish. We want and need the patron to prosper, and in turn, we, Ag Plus, will prosper. So with that, I'll let Todd fill in a little bit too.
Thanks, Mark. Yeah, I'll make a couple comments around that. As Mark said, we tried a lot of things on. Over the years, I've had the fortune to be involved in trying to come up with a lot of different mission statements for various organizations. I've been a part of a number of organizations, and I've seen some pretty grandiose mission statements. The challenge is always, can you remember them? Can employees remember them? Do people get them? And a lot of times they get long enough where people simply give up on trying to remember what it was, or they get pieces of parts. So, you know, we really worked to boil it down as simple as we could. And I guess if we really wanted to even simplify this further, we could just say enhancing prosperity. And that's really what this whole thing is about. It's about Ag Plus enhancing our communities, our patrons, our employees, really all the stakeholders, and doing what we can to make all those stakeholders' lives enhanced and better. So I think the board put a lot of work and effort into it, and I think they kind of hit it out of the park. Short, simple, but it's really all encompassing. So we get up every morning as employees, and that's what we try to do. That's our purpose in life. The purpose here at work is to try to make things better and make people and stakeholders prosper every single day. Moving into a statement of operations that we would normally cover at an annual meeting. So net sales for Ag Plus first year, full year of $65.3 million. We had total gross revenue of $17.7 million, and operating expenses of $17.2 million. That gave us local earnings from operations of $504,298. We had investment income of $377,234, and we had patronage dividend income of $708,709, which gave us a total after-tax savings of $1,324,236. I want to circle back and spend a little time on this slide. It's kind of an opportunity to do a little education around cooperatives, and I know many of you are familiar with cooperatives, but I thought I'd just take a second and explain a few things. So we have two types of, actually on this particular earnings statements, there's three types of earnings we have. We have local earnings, which are earnings that we generate here at Ag Plus from the direct business we do with patrons. So if we sell a ton of fertilizer and we make $1 on it, that goes towards the local earnings. And then we have investment income, which Ag Plus owns a portion of an energy company. And so the $377,000 represents our share of profits in that company, which we own. Now we separate that out because it's a different company, it's different management. We can't really control how well that company does or doesn't do. So we show that as investment income. And then lastly, we have patronage dividend income, which is income that we're getting from regional cooperatives like CHS, Land O'Lakes, CoBank. So we get that income just like our patrons get from us. When those regional cooperatives make money, we get a share of that, and just like we do with our patrons. You know, the cooperative structure is a bit unique in that it's a single taxation. So when we earn money at the cooperative level, we can allocate those earnings in the form of patronage, and we aren't taxed on that. It goes out and you as members get taxed, but the co-op does not. Whereas a corporation, they get taxed twice. They get taxed on those earnings, and then they get taxed on the dividends when they go out. So the cooperative has a bit of advantage on a tax standpoint. You know, co-ops were started, you know, some of the early ones way back in the 1500s, but modern day co-ops, you'll see a lot of them that were started in the early 1900s. And they were started because as producers were trying to get a fair price for their goods and services and buy products at fair prices, they had a tough time really dealing effectively with big national companies. And so there was a lot of them formed, and it was a way to avoid the antitrust laws. In fact, when producers in the beginning of the 1920s and 30s were trying to buy some stuff together, there was a lot of lawsuits filed against them, and they really had a tough time getting fair prices. So cooperatives were formed. They've been around for a long time now. People kind of take them for granted. But I can assure you, if they go away, it'll be a whole new world to try to do business with when you have to go out there on their own. Right now, private businesses know that they got to be in the ballpark with what cooperatives are doing, or they're not going to get the business. So it keeps the corporate type of businesses honest. So cooperatives are very important. From a balance sheet standpoint, we have total current assets of $26.5 million, property, plant, and equipment net of depreciation of $16.2 million, equity in other companies, $17.1 million. That would be primarily your regional cooperatives again, and the vast majority of that, I think, is about $13 million in CHS. Total assets of $59.9 million. Flipping to the liability section of the balance sheet, We have total current liabilities of $19.7 million, total long-term liabilities and taxes of about $7.9 million, which gives us members' equity of $32.3 million. And really what that members' equity represents is the value of Ag Plus since day one. And when I say day one, that goes back to the legacy cooperatives and whoever they may have been a part, but it's an accounting from day one when the first co-op of this company started. It's all the ins and outs, the earnings, the losses, the assets that have been purchased and depreciation. So it kind of tells you from a book standpoint, Ag Plus is worth $32.3 million. Now we all know that if we were to go and market Ag Plus, it would be something different than that, because we have some things that are depreciated on the books but are still worth things. And so it's just it's from a book standpoint what Ag Plus is worth. And then you have total liabilities and equity of 59.9, which factors your assets and puts us in balance. I'm going to talk a little bit about some key financial numbers now. Working capital, we have $6.8 million of working capital. And the way working capital is calculated is, if I get going the right way, you take total current assets of $26.5 million minus your total current liabilities of $19.7 million. And that gives us the working capital of $6.8 million. All of you know, from the farm, you have working capital, and you use that working capital to pay bills, make payroll, purchase things. And so we do that as from the cooperative standpoint as well. Now, one thing also from a commercial standpoint, when we go to borrow operating money for the year, a lot of the banks will kind of look and say, okay, we'll give you somewhere between 4 and 7 times the working capital as an operating line. That's what they're willing to give. So if you take 6.8 times $4 million, you get somewhere in that neighborhood of $26 million. And that's really what Ag Plus used for operating money this year. We had about a $26 million operating loan. And that's about what it takes for Ag Plus to be able to do prepays to our vendors and make sure we're maxing out all our discounts and taking advantage of everything so we can be as efficient as possible. So working capital is important from that standpoint. Another ratio we look at, debt to equity, about 24.1%, and that's taking the equity, that $32 million, and looking at the debt that's associated against it. And so 24.1% debt to equity is actually fairly low, fairly conservative. If you look at kind of a guideline there, 40% is kind of the top of where an organization of our type would want to be long term. Now, cooperatives go above that 40% pretty commonly. A scenario where you might do that is if you're going to buy an existing business and you look at the returns and they're good returns. So you may go to 50, 60, 70, maybe even something over that for a short period of time. When I say short period, years, a few years, but you wanted that to come back down. Conversely, if you start to get a really low debt to equity number, then you start questioning yourself, are we really making our equity and our money work hard enough for our membership? And so as I look at our long-term debt to equity, we had a $1.4 million PPP loan that we received. And so if you remember back to the previous slide, our long-term debt was $7.9 million. So if you take that 1.4, if I can get my slide to move, you take that 1.4 out of that, and that brings that long-term debt down to about $6.36 million. And so then when you do the recalc on that, we're down to about 19.7 million on debt to equity. So again, means you got a really good balance sheet. It's good and strong, but it also means there might be some opportunities for Ag Plus to make some investments, look at some additional equipment, facilities, personnel, whatever it is to, again, help our membership prosper more. The last number on the slide, you know, we had about $535,000 of what I would call first year merger expenses, for the most part, one-time stuff. And some of the bigger things on there would have been, you know, accounting software systems, logos, advertising, bringing systems together, some professional fees. And so it's not uncommon at all, but we're optimistic that a lot of that $500,000 will go away and go towards being more efficient. Member benefits and highlights. So this first year, we were able to pay all the states that were requested. So we paid out $174,335 in cash for estates. We had equity retirements that were requested of $393,807, and we paid those out. Cash patronage, we're paying out $250,000 of cash patronage. And those, matter of fact, those checks were put in the mail today. So those will be coming out to you. And then we take those and add them up, and you get $818,142 in cash that was sent back to the members this first year. In addition to the cash, we also had deferred patronage of $250,000. So that'll be coming out. Capital expenditures, we've spent $1.4 million on equipment and facilities. And we had some new services added in precision ag equipment and service. So those are some of the items and the benefits. You know, I might just mention here from a cash patronage standpoint, we did pay out 50% cash on the patronage. A lot of years, typical, maybe you'll get a 30% cash payout. And as all of you know, you're responsible to pay the income tax on whatever patronage you get allocated. And if it's a 30% cash, most of that money gets used to pay income taxes. At a 50% cash payout, you get to pay your income taxes, and you probably have a little bit left over to actually spend. So I think that was a good little benefit to members this first year as well.
So what we are paying back for each of the different parts of our company here under patronage rates is agronomy, we're paying 1.16% of the dollars spent. Refined fuels, 0.58% of the dollars spent. Propane, 1.51% of the dollars spent. And other merchandise, which would be like some stuff with the C-stores and stuff like that, 1.7%. And through the audit process, our auditor defined these would be the patronage rates for our first fiscal year. And with the complications of pulling three different co-ops together and how they did things differently in the past, this was necessary that we would pay it out at a percentage of dollars spent instead of by gallons this year on the fuels. We do plan on paying out on a per unit or gallons basis in the future. Todd will explain that a little bit more.
Thanks, Mark. Again, as Mark said, as we brought three entities together, one of the entities paid everything out in percentages. And I'll talk a little bit more about this later, but we ended up running three different accounting systems for 10 months of the first year, just because, and I'll talk about the number of challenges. But really what that ended up doing was we simply weren't able to break out and have the information to pay by gallons because of that situation. So yeah, as of July 1st, we're all on one new accounting system, and we will be able to get that all broken out and be able to pay out by gallons or by quantity where it makes sense and what normal practice. But then again, you know, what is normal practice? We had one of the three legacy co-ops that paid by percentage, so it's all what you're used to. So, but it probably will have some stuff next year paid out by quantity rather than a percentage.
Todd did touch on that. We're pulling 3 different books together for 10 months out of the year. And I know some of that was a bit rocky, and we want to thank you, the patrons, for kind of, bearing with us, and it will definitely be good going forward.
I think everybody's aware, but we did have some management changes over the first year. Emmett Thompson, who was the general manager of Prairie Pride at the time of the merger, resigned. He was done about a month or so after the merger, and that was planned. That was part of what people knew going into the merger. A few months into it, Pete Schmitz, who had been the general manager at FCA, decided that he wanted to take a different opportunity, and so Pete resigned. And then lastly, John Head decided that he needed to, for some personal reasons, he actually retired. So he left Ag Plus as well. And so I'll talk about that a little bit in the future too, but that's a lot of talent, a lot of know-how, and a lot of institutional knowledge that left the company. So, Mark and I both want to extend our thanks to those 3 gentlemen for their guidance and all the years that they were here, and also in all the work they did to get the merger to come to fruition.
Absolutely.
So moving on to Ag Plus leadership team, and the Ag Plus leadership team is, I guess, simply some of the key management that has been put in place to make sure that we have success here at Ag Plus. So I've got Don Brown, and Don is heads up the agronomy operations. So Don's responsibilities are working with the staff in the agronomy division to coordinate everything that happens in the very busy times that we have. You guys know how busy it gets in the spring and the fall, and Don coordinates all the things that happen between employees in 3 locations and equipment going to the right place at the right time. Is responsible to make sure that the equipment's all ready to go, that facilities are ready to go, and that everything runs smoothly. So Don's got a pretty big job that he holds, and as the company continues to grow, it becomes more important that we work well together and drive those efficiencies out. Angie Hazelbus is the controller for Ag Plus. So Angie's duties, she is responsible for all the accounting functions that happen within Ag Plus. Everything reports up to her. She works with getting all of the equity things that need to be done so we can track equity, pay out patronage, do equity retirements, do the estates, all of that piece. Much of the reporting that needs to be done from government regulations, and really helping management and the board get good financial reports so we can see what's going on and manage the company. Cheryl Clays is our business analyst, excuse me. And so Cheryl is really responsible for, and I'll talk more about it later, but we've got so much data and so much information available in helping us sort through all that information and figure out what it means and look at things that can help Ag Plus as a business and shed light on some things that we can bring to our customers and help them. So she plays a big role from that standpoint. Andrea Pyle is Human Resources Manager. And so Andrea is responsible for all things in the HR, all the insurance stuff, workers' comp things, all the benefits and employees and health insurance, reporting around all that stuff, payroll, taxes, payroll, a lot of reporting into the federal government and state government, a lot of training, onboarding new employees and giving them training. So she has a big role to play there, helping employees with things, sourcing employees, hiring employees. And, we do have you know, because we have a number of C stores and retail businesses, we have, you know, that business has a fair amount of turnover. So there's a lot of employees that she touches every year. Justin Ronick heads up our agronomy and, you know, drives that sales team and overall planning for agronomy and leading that division to make sure that we are staying on the kind of bleeding edge of things and making sure we're staying up to date on technology, making sure we're getting things purchased. And I go back to Don, they kind of split. Don Brown kind of works with crop protection. Justin does fertilizer and seed. And so Justin plays a big role in pricing and sourcing and making sure that we have programs out there that are beneficial to our producers. Liz Rangens, environmental health and safety. Again, a lot of compliance things. She handles all the DOT regulations, the driver's files, OSHA 900, OSHA incidents, accidents, investigations, safety training, safety plans, and really creating a safety culture within Ag Plus. And safety is really a huge thing that's important, not only to employees, but to customers as well. You know, we work in an industry that has some dangerous products. You know, if propane is not handled and done correctly, that can be very dangerous to employees or customers. We have anhydrous ammonia. We just have a lot of things that if you handle them safe, they're fine, but it takes some education. And so Liz is responsible for all of that. Adam Steffes heads up the energy group. And so Adam has the bulk fuels, bulk oils. He handles the propane, is responsible to make sure we have drivers and that we're doing routing correctly. We have product bought at the right place and the right time so that we assure supply for our customers. And so Adam heads up that piece. And then Steve Train heads up our service businesses, which would be our convenience stores, our Tires Plus, our Parts City, auto parts store, heating and air conditioning, small engines, and a number of other smaller ancillary businesses that we have. So that's kind of the leadership team. And, you know, there's quite a few people on the list, but if I look at Ag Plus, we have a lot of different businesses that we're in. If we break them all down, we have like 20 different business units we have. So when you have that type of broad divestiture of businesses, it takes a number of people to make sure that those are all operating smoothly. Remember, you know, if you have questions, you can raise a hand or type in your question, and we will also take time at the end to ask for questions too. But if you want to ask something where we're going, feel free to do so. I talked about new assets that we put in place. Just a little bit of a breakdown. We had IT, fiber optics, and software getting set up as a new company to make sure that we could communicate between locations and that we have a new software available for our accounting. And, you know, there was about $120,000 spent on that. A couple of big items. We had 2 new airflows that we put into service. So that was a really $670,000, so a good chunk of that $1.4 million. We had equipment that came off lease that we had to purchase. There was a couple of semi tractors and a couple of floaters that came off lease. And then just miscellaneous equipment and repairs, $412,000. Seems like a big number, but when you look at all the facilities and all the equipment that Ag Plus has, things add up in a hurry. You know, we did out at our West Branch location, the agronomy replaced part of the tower, and you know, things like that add up very, very quickly. So again, those total capital expenditures were about $1.4 million. Merger challenges. I said I'd talk a little bit about these. Mergers are always a challenge to bring together. When you put two companies together, it's difficult. And when you put three together, it's not three times, it's just difficult. It's some multiplier of that. Just even getting common language between three different companies is difficult. Three different companies will look at the same word and it'll have a different meaning for each company. And so it takes, it's probably taken us the better part of the first year just to get a common language and understanding of what somebody means when they say it, so everybody understands the same thing. And culture, they take a long time to change. If I look at some of the mergers that have happened throughout the cooperative system, the one that I'll go back to, I spent about 12 years working for CHS. Actually, when I started, it was Cenex, and then Cenex and Harvest States merged. That was back in 2000. Fast forward to today, 21 years later, there's still some cultural differences if you explore that organization. So it takes a very long time to completely meld cultures, but we've come a long ways in the first year, but that's always a challenge. We had three totally different accounting systems. Again, so back to everybody does something different. What one company may call supplies, another company calls it repairs. And so you got to get that all in the same place so it makes sense from accounting system standpoint. We had some difficulties in putting the three systems together. We knew right from the beginning we wanted to go to one system. But when you go, there's a lot of training involved. It takes time to get people trained. And so we said, we have an effective date of August 1st. There was not an accounting system chosen. So starting August 1st, we had to choose what system it was going to be. By the time we got that done, we said, boy, we better not put a new accounting system in right before our fall busy time. So we waited and went beyond that, and then COVID-19 hit. So we actually ran, as I mentioned before, 10 months on three systems. We kind of did that a little bit of a conscious decision. We said there might be some internal pain, but that's probably the least amount of pain for our customers. So we did suffer internally, but I think for the most part, our customers didn't feel too much of it. And then the other thing that kind of set us back a little bit there is we actually had a cyber attack. One of the legacy accounting systems back in September of 2019 got attacked, and they attached ransomware to our accounting system, which totally locked us out for about 30 days. We ended up hiring some, third-party legal team, a third-party expertise in handling these ransom issues. They advised us, we paid some ransom. Ultimately, we got our data back, but it was a long process. It hindered our ability to try to put the accounting system together. Really created quite a challenge for us. But so some people are thinking, well, what was wrong with our system? Gee, how come you got hacked? We learned some interesting things. Back at that time, across the United States, there's a company that gets hacked every 30 seconds. So, at the same time we did, it was the same group that hacked. There was a number of hospitals across the US that were also held with ransomware. So it wasn't, I guess it was kind of the luck of the draw. We got the short straw, and it wasn't anything we really did wrong. One thing we did do right is when we started up Ag Plus, we looked at our cyber insurance, and we took a pretty robust plan. So we had really good coverage for this cyber attack. All added together was well over $100,000 in expenses to get that fixed, and we ended up with a $10,000 deductible. So we came out of it pretty well. Obviously, we had a lot of people's time and everything, but so a learning experience. It was quite the thing. As I mentioned before, we had the departure of 3 general managers, and whenever you have a senior level employee leave, there's always some disruption. You go through a process to replace them, and then they bring in new ideas, and there's a little bit of a culture change. All the employees that report into them have to get used to a different way to do it. And so that was a bit of a challenge to get through that, but it went relatively well. And then we had COVID-19, and that of course brought regulations, it brought more red tape, lost businesses. For about 2 months, our retail business were down about 50 to 60%. We had a number of Ag Plus personnel that either had the COVID directly or had family members or were exposed to it, so they couldn't work. And, so that created a challenge for us. We ended up coming into spring, we had a lot of our key agronomy people and energy people kind of work from home to try to isolate to make sure we had enough staff when it got busy. And the COVID-19 thing has created a communication challenge. Just like we're right now, normally we'd have an annual meeting in person. Can't do that. So we're finding new ways to try to communicate with our membership. From my standpoint, I feel bad. I've met some of our patrons, but not nearly as many as I would like to have. Normally, the first couple of years, I'll do a lot of meetings, go to a lot of places, invite patrons in, meet in small groups, just to get to know people and have people get to know me. I got the first series of those done. I think I got 3 of them done January, early February. COVID hit, and there we went. So, and it's created even challenges to how do we communicate to our employees. We spent a lot of time where we didn't want to get employees together. As management and the board team, we had some issues with how do we communicate well with the board. So that was a major challenge. And then on top of that, we had a little hangover from the 2019 prevent planting. There was 40% of the acres that didn't get planted. And I'll talk a little bit more about that in the next slide here, but that was also a challenge we had to get by.
I would like to take the opportunity to thank Todd, his management team, all the employees, and you, the patrons, to helping us get through those challenges. It could have been much worse. So thanks to all of you.
Some of the financial impact of those challenges, again, I talked about the one-time merger costs of about $535,000. The prevent planting, when we do chemicals, the rebates are always a year later. So when we had a 40% prevent plant in 2019, those rebates normally would have come into our 2020 year numbers. And so there was about $800,000 of chemical rebates that we normally would have gotten that we were short. We just didn't get them. We had about $50,000 in direct COVID-19 related expenses. Those were the ones we could easily identify. We had probably a lot of overtime we paid because we had people out sick, other people were covering, just a whole lot of inefficiencies. But, you add all those together and there's, almost $1.4 million of financial impact to our first year earnings. So fairly substantial. Going on to highlights, so we had a lot of good things happen the first year. As I mentioned, we migrated to one state-of-the-art accounting system, which is AgVance. It's a great system, and we were able to get migrated to that on July 1st. As I also mentioned, we have a management team in place. I think we really provided great service to patrons. I go back to the fall of 2019 and look at what happened in propane. We had a big dryer season. There was tremendous challenge on supply. We had a lot of competitors that ran out of propane. We did not here at Ag Plus. We were managed to, through some contracting and some rail that we bought, some good management by the energy department, we kept our patrons in supply. We had growth in agronomy and agronomy expertise, and we had expansion of our service businesses. If I go back to service on, agronomy, did we get to everybody, every patron the minute they wanted them there? No, but that's not unique to Ag Plus. As I talked about in the meeting yesterday, we all know, and we see that every year, there's a short window of time. Some years it's maybe as short as 3-4 days. Other years maybe stretches out to 7 to 10 days. But if you get planted in that magic window, you have maybe a 15 bushel acre advantage of not getting planted in that window. So everybody wants to get planted in that magic window. And from a business standpoint, there is no way we can have enough equipment, enough people to plant all those acres in 3 to 4 days. It just physically can't happen. So we manage that to the best of our abilities. We continue to look at that every year as we add equipment, facilities, and people. Try to keep getting better and better at that because we know it's extremely important. But overall, as I look back at our first year, I think we did a pretty good job of getting most people reasonably serviced. And, it happened, I go back to the spring, we did about 80% of our spring agronomy business in 7 days. So it does get to be a challenge. And lastly, we were successful and remained open and viable through the COVID-19 pandemic. And so as I look at that, those are definitely some highlights through the first year. In addition to that, as I already mentioned, we had $1.3 million in earnings the first year, $818,000 in cash that we returned to our patrons, the $1.4 million in upgrading equipment and facilities, $250,000 in deferred patronage, and then we also increased our balance sheet strength from a retained equity standpoint by $830,000. So if you add up the 818 and 1.4, the 250 and the 830, that's about $3.3 million of direct value that was added to the patrons in this cooperative the first year of a three-way merger with the pandemic and coming off a prevent plant hangover. So, I think that was a tremendous success. I think that showed great vision by the board of directors in putting the merger together and making that happen. It was a great execution by the employees of Ag Plus to make that happen. And it's a credit to all of you as patrons in the support that you gave to Ag Plus and your understanding of some of the things we had to get through the first year, in your support from buying things from us and using our services. So thank you for that. So starting to look a little bit forward, we're positioned well for our second year. As I said, we have the new accounting system. It's up and running. It's starting to really provide us valuable information to manage from an internal and to help, again, add some more value to our patrons. We had a really good fall in agronomy. Weather was conducive. It didn't look that way. Looked like it was going to be kind of a disaster there when we got those 2 snows, but it ended up getting nice and we got a lot of things done. We do have some headwinds in the energy division. Propane, our volume of propane is way down, and mostly due to we really didn't have any dryer gas that we sold this year. And once we got through that season, we've had extremely nice weather, which everybody enjoys, but that's cut into our propane volume as well. So that we're facing a little bit of headwind there. Our retail businesses, again, we're nearly back to pre-COVID levels, so that's encouraging. Our new bulk seed facility in West Branch will be fully operational this spring. And for those of you who may not be aware, we are in the process of building a new bulk seed facility in West Branch. It consists of 6 tanks, a big shed, automatic treater, and so we can automatically treat seed. We can do totes, we can do shuttles, and we can treat whatever volume of seed you want. So it's not just bulk. If you're normally used to getting bags, we can treat a small amount and put it in a shovel for in a cube for you, and you can get your seed that way. But it's extremely efficient. We're excited about it, and if you drive on 19 past our West Branch, you'll see it sits right out front there. We have a new refined fuel truck and a new propane truck in our fleet. We put those into service shortly into fall, so that definitely helps out and makes us more efficient. We also have 5 new semi-trailers with unload conveyors out the back, so we'll be able to haul and deliver bulk seed. We can also take those conveyors off, and we're hauling and have been hauling a lot of our own fertilizer. So we're able to use those trucks throughout the year and be more efficient, and also provide a great service delivering seed. And then lastly, we budgeted to upgrade and add about $2.4 million of equipment and facilities again. So, you know, again, as I think about it, we're positioned very well here going into our second year.
Do you want to touch on that a little bit more, Todd, about how, I know you've said in the past that you have to, you know, it's kind of a smart move to spend what your depreciation is each year on?
Sure, good point there, Mark. You know, another rule of thumb is, you know, you want to, over time, you pretty much want to be spending about what your depreciation is every year. Ag Plus, we're right at about $2 million in depreciation every year. If you don't spend that much money, over time, you're going to end up with just a bunch of old, worn out equipment. So if you aren't spending, in our case, $2 million plus, 4, 5, 6, 7 years from now, yeah, earnings look good, but at the end of that time, we'll have a bunch of rundown, worn out equipment, and that certainly is not going to service what our patrons want and need. So, and we look at what's going on in the industry and the economy. If times are tough and producers are struggling, generally that means the co-op is going to struggle a little bit, and so we may cut back and not quite spend that depreciation. You know, first year out, you know, I mentioned I think we budgeted about 1.7 and we spent about 1.4, because as we looked at things coming out of 19, coming off a prevent plant and producers' earnings down a little bit and some pretty uncertain times, we were a little bit more cautious. Coming into this year, things looked a little better. We started to see some better commodity prices. Economy looked like it was pretty strong, so we spent a little more on that 2.4. So we'll look at that, and we will go back and forth. But over the long run, we're targeting to spend about, on average, our depreciation.
As I touched on earlier in the meeting, we went over many different things at that two-day planning session we had. Discussion of direction that was provided by the facilitator that actually has a lot of experience in, you know, organizations like this, and bringing, you know, when we brought 3 different co-ops together, kind of all the things that go along with it. One of the things that was decided that the appropriate board size for Ag Plus at this point in time would probably be to go down to 7 members. We were at 9. And to actually make that happen, 2 of our directors decided they were ready to leave the board after many years of service. That was Jim Larson and Al Steffes. Both of those guys had a ton of experience, had been working with the cooperative system for years, and we owe them a big amount of thanks. It was decided that they would step down prior to the first annual meeting, and they would not be replaced, which would leave us with 7 members. So with Jim and Al departing, you know, their seats will not be filled. So the following directors are up for election this year. Doug Leysen, who's a little bit north of the Ghent area, Peter Haugen, who's a little bit north of the Canby area, and then Jim Larson, who was from down by Sleaton. Jim decided that he was retiring from the board and his seat would not be filled. So basically it came down to Doug and Peter were up for election this year. So with that, a number of the board of directors went out and visited with different patrons about running for the open positions to see if there was any interest. We actually did not really find any interested eligible candidates. I think part of that was just the year that we had went through with, COVID and everything else, and there wasn't a whole lot of interest there. So what the board did was appointed the following current board members to another 3-year term, and that would, obviously be Peter and Doug. And because of COVID-19 and no official annual meeting, these 2 directors will have to be confirmed by the membership at the next annual meeting. So next year, hopefully we're post-COVID by that time, and we'll be able to have an actual annual meeting. We will have to have you, the members, actually confirm these 2 board members. And I guess one other thing is, we're put a lot of thought into this, and we're trying to have it so the board will basically represent, the wide geographic area that we cover. And part of that was at our retreat, we did kind of try to come up with some maps and stuff, and Todd can probably cover that a little bit, I guess. So
Sure. As Mark mentioned, that was a piece of the retreat to figure out not only board makeup, but how do we have territories? Do we have zones? Again, the board's desire was to make sure that they had representation for all members, and you didn't end up with maybe all board members for one piece of the trade territory or something. So, they did have a pretty robust discussion around that and came up with a pretty good plan. Normally, probably if we were in person in the annual meeting where we could explain it and show some good slides, we'd probably go through it. So our plan would be to go through that at our next annual meeting, but we wanted to share that that is the intention, to make sure that there's good representation for all membership, and when we're able to get past COVID and get back in person, to lay that out for everybody. All right, switching gears a little bit. Where's the ag industry going? As I look out across the industry and read things, talk to colleagues, try to read some tea leaves, it looks like we're going to see continued consolidation. Why do I say that? Well, the driving forces are behind that. Number one is the efficiencies. When the study was done for this 3-way merger, they looked at it and said, it looks like there should be about $800,000 in savings and efficiencies by combining these 3 organizations. And everybody realizes that's not going to happen 1 year. It takes probably 3 or 4 years to happen, but that's what was identified. If I go back to a previous experience I had in a previous merger, bigger organization, but it just goes to illustrate the point. That one, there was about $7.5 million of savings and efficiencies that were identified. And 2 years into it, we had already driven out $9 million. And then I can go a step beyond that. Land O'Lakes, which most of you are familiar with as a regional co-op, decided to do a merger study with United Suppliers, who was also a regional cooperative. I was on their board of directors, and United Suppliers supplied a lot of fertilizer and crop protection and seed, along with some other smaller business items to local co-ops and private businesses. And so when that merger study was done, they identified about $70 million in savings and expenses, efficiencies that could be saved. So when you look at that kind of money, as long as that's out there, it's going to continue. A lot of times people say, well, it's got to stop at some point. And so that's why I illustrated it just doesn't seem to stop at numbers. The bigger the companies get, the more efficiencies that drop out. So I don't see the consolidation stopping. Another piece of it is attracting and retaining employees. Employees want opportunity. They want to be able to grow. They want to be able to take on more responsibilities. And as organizations become larger, it's easier to do. It's easier to provide opportunities for employees. It's easier for them to see opportunities. And so therefore it becomes easier to attract and retain those employees. And, out here in rural Minnesota, we need all the advantages we can get. It becomes difficult sometimes to attract good employees because you have spouses that in a lot of cases work and want to have opportunities. And so it's to the point where it actually drives some consolidations. Challenge to profitability also is going to continue to push consolidation. If y'all remember back to 2008, 2009, when commodity prices were going through the roof, and at the same time, yields were having a pretty good increase. A lot of money being generated out there. Producers were expanding their operations, speeding up, going from 12 row planters to 24 to 36 to 48. Yep, I got a 48, but I can't get everything done, so I'll keep the 36 too. I can't get into every place, but in the meantime, the cooperatives and private business, for that fact, were like how are we going to keep up to this? How are we going to get all this done in shorter and shorter periods of time? And so we started spending money. We added equipment. We started building facilities. We were building mega fertilizer plants that were costing $25, $30, $35 million. We're putting up shuttle loaders on the grain side that cost $25, $30, $40 million. So got all that stuff built, and we all know what happened. Commodity prices went back down and things slowed down. But guess what? The interest cost and the depreciation didn't change. That's still there. And so you find a lot of these businesses today that have a little hangover with interest and depreciation. So that challenges the profitability for a while yet. Producer profitability, when I put these slides together and started thinking about this a number of months ago, looked a little different than it does right now. And after today, it probably looks different than it did a couple of days ago because, not only, first we kind of saw some nice rallies in the market. We saw some, money come from the government, but flip side of that, now we got fertilizer prices that are running pretty hard. So I think producer profitability is always a challenge out there, and that always, whenever the producer struggles, it spills right over into the egg sector. And then, I just got to believe the government payouts are likely going to be less. For past elections, they've already spent, more money than I can even fathom. But so I think, that's going to weigh on things a little bit too. Talking about where things are going, I think the big thing that it's been there for a couple of years, but it's just going to keep accelerating is technology. A couple of fun facts. Maybe, as I think about it, every day there's 2.5 quadrillion bytes of new data made. I don't know what 2.5 quadrillion is, but I know it's a lot. Something a little easier to get our minds around is 90% of all the data that's available today in the world was created in the last 2 years. I think I'll repeat that one. 90% of every piece, every scrap of data that's in the world was made in the last 2 years. I mean, that's almost unbelievable. So my point on that is, how can producers even begin to sort through all the new information, all the new data that's out there, everything that could potentially help you prosper? And so I see that as an opportunity for Ag Plus to step in and help make use of some of that information, particularly when it comes to using real-time information to enhance crop development. There's all kinds of opportunity. We've got the traits out there from the genetics are, the money is spent on them is kind of slowed down. They've done a lot of what they're going to do, but there's a ton of opportunity in things we can provide to make that crop perform while it's growing. And so I think there's a lot of opportunity there, and we're going to be looking a lot at that. Another area is increased electronic business, the use thereof. We see that coming where people are going to use types of platforms to maybe contract, want to be able to pay their bills, want to look up their accounts. They're still going to talk to our people, and there's still going to be communications, but there'll be a lot more business conducted electronically. So I'm kind of excited. We signed an agreement here a couple days ago. We're bringing on a new platform that will be available. Our goal is to have that up and running by spring, whereby you'll be able to go down and download an app to your smartphone. You can do it on the computer too, but another little fact, 90% of the e-business that's done is done on a cell phone versus a computer. So it'll be an app, it'll be easy, but you'll be able to come in and see all your information from an Ag Plus standpoint. You'll be able to look at your accounts, your contracts. We'll be able to send out offers. You can go ahead and do contracts. You can sign electronically if the signature is required. We can send out quotes. There'll be reminders sent out. You'll be able to pay your bills through ACH or credit card if that's what you desire. And so you can still do business like you've always done it if you want. You'll be able to do a mix of it, but it'll be a pretty nice platform and really put us kind of get on that leading edge. We don't want to be in the bleeding, but I think it keeps us up there in that leading edge. So that's kind of an exciting thing coming forward. I also see dramatic increase in regulatory environment. I can see it coming on the federal side. Everybody remembers the waters of the U.S. Again, I'm not taking sides. I'm just merely reflecting the political environment. But as I understand, there were 17 executive orders signed today. I think one of them includes shutting down the pipeline. So I'd be shocked if we don't see some piece or portion or mirror of waters of the U.S. coming back at us. Sometimes that creates opportunities. Sometimes it's a challenge, but I do see more government regulations coming. If I look at it from a state level, Minnesota is in a political climate right now where it wants to look more like California. Again, I'm not going to judge. I think we all want to be and are responsible to the environment. I know all of our patrons care deeply about their land and their water and do best practices and are very proactive in that, but sometimes governments want to, reach beyond that and put things in place that just don't make sense and they make us all inefficient. I know Minnesota's going down the road already to meet the same standards on emissions for vehicles as California. And so we've got that regulatory environment that's coming. Kind of as a summary comment, from an Ag Plus standpoint, we're focusing on, as I said, producing and enhancing the prosperity of our stakeholders. So we're going to continue to spend our capital on products and services that help get things to customers faster and more efficiently. So that's kind of where I see ag industry going. That kind of concludes the end of our prepared comments. Just as a closer here, really want to thank you for your support and the business that you've given to Ag Plus over the last year. I know there's been challenges. Everybody's learning new things, new services, new systems, new people. And so I just really appreciate the patience and support that you've given us.
And I guess I would just echo Todd's sentiments there that we really do thank you for your business. Without you, we wouldn't exist. So we're going to do everything we can to keep pleasing you and service you guys in the future. So with that, I don't know, does anyone have any questions?
Okay, looks like we have a question here. I'm going to take you off mute, potentially.
Are you there?
What's that? Yeah, okay. There, okay. All right, we've got a question from Alan. Alan, go ahead. Can you hear me okay? Alan, there's a little, you'll see a little microphone probably on the bottom left of your screen. It's got a red hash through it. Okay, can you? All right, I think you got it now. Now I can hear you. Go ahead.
Okay, my question's about stock retirement from the 3 different companies. Probably had different age groups, you know, what they retired at, and then what's going forward with how the stock is going to be with the new company.
Sure. All right. Mark, do you want me to start? Or
Yeah, you go ahead.
Okay. So the question was, what's the equity retirement plan? As the 3 companies went through and did the merger studies and the board talked about it, in the plan of merger, what came out was that the 3 legacy companies would retire the old equity per the legacy company guidelines and what they had done. So each company had their method and rules for retiring equity. And so all the old equity that was out there will get retired under those 3, how those 3 did it. Once all that old equity is retired, then Ag Plus equity that was earned since this started, so since August 1st of 2020, will be retired by years earned. So we'll get away, there'll no longer be any age retirements. It'll go by years earned. And as the boards thought about that and thought through that process, they said, you know, that might be, you know, a better way to do it from a standpoint of some younger producers will get some equity. They won't have, if you have a 20-year-old producer that's a member, they don't have to wait 45 years until they're 65 to get something retired. They'll get some of that equity retired by age, or excuse me, by year earned rather than age. So again, the plan of merger called for the existing equity that was brought into the organizations to be retired under the legacy plans, and then new equity earned in Ag Plus will be retired on years earned once that old equity is paid out. That makes sense, Alan? Did I answer that for you?
Yes, it did. Thank you.
Okay. No. Anybody else have a question? Again, if you want to ask a question, there's a symbol down there that you can click on. It's a little hand. It'll raise your hand, and I can take you off mute. Not seeing any questions. I'll just give it a couple more seconds here. If I don't see any questions, we'll go ahead and end the webinar. See something, Mark? All right. If you don't see any question, again, thanks for joining us tonight. Thanks for your support, and have a great rest of your evening.
I agree. Thank you.